Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
Hello.
We are here, and today we wanted to talk a bit about alternative investments. Some people call them alts. Corey's going to do that. I'm not because I feel like it's weird. And the title of our episode today is Do You Need Alternatives in Your Portfolio? And I think we can pretty much say the answer to that is no, you probably don't need them. But whether or not maybe you should consider them in your portfolio and in your investment strategy, that's probably a good thing to talk about. And we'll talk a little bit about pros and cons of these alternative investments, as well as like different kinds of alternative investments and when it might be a good idea to potentially consider them. In recent years, alternatives have definitely become much more accessible to individual investors. You used to need to kind of know someone or have a lot of money to invest in them. There's a certain term in investment world that's called accredited investors, and a lot of them you still need to be an accredited investor to qualify and be able to invest in them. And that just means that your net worth is worth $1 million or more, and or you have a certain amount of income per year. I think it's like 200 or $250,000 if you're married. So assuming you kind of met that criteria, you could potentially invest in these tools. But a lot of times you also have to have a large amount of money as your initial investment. Like maybe you can't buy in unless you have at least $100,000 or at least $50,000. And some of them nowadays you can get into with quite a small initial investment, which is helpful. And others you may not even need to be an accredited investor for. And it always depends on like the specific tool that you're looking at, a specific investment strategy. But we're going to go through a few advantages and disadvantages and then some of the different tools that you can potentially use. I don't know. Do you think tools is an appropriate word there, Corey? Yeah.
Tools works.
Okay. Tools.
Yeah,
Yeah.
we'll go with that one. So
Yeah.
definitely some advantages and disadvantages with everything. It's not for everyone, maybe not for anyone, but advantages of alt. So diversification, I think, is worth noting because that definitely is true. Most alternatives don't move in tandem with the stock market or the bond market. So if you're looking to diversify beyond a well-rounded, globally diversified stock and bond portfolio, which, as Rochelle mentioned, is probably all you need. But if you want more diversification than that to try and get a smoother ride or whatever the thought process is, then yeah, it could be worth considering alternative types of investments. Um, there's in some cases potential for greater returns, obviously not guaranteed. There's also potential for greater losses in a lot of cases. Some of them have also downside protections. Again, talking about smoothing out the ride. Some are designed to produce income, so you potentially could get more recurring income from some of these strategies than you could from a traditional bond portfolio or money market or CD. Um, the private credit, some real estate funds, income notes, etc. So we'll breeze through all of these. We're not going to do a deep dive on them because literally each one would be their own podcast episode. But we'll kind of hit on the high notes um, and go from there. But what are some of the
Yeah.
negatives or disadvantages of alts, Rochelle?
Sure. We have recorded a couple of episodes on some of these specific ones. So, like on direct indexing and structured notes, I think. So, if you ever have any questions about those, you can always dial back to previous episodes. There are obviously always disadvantages or pros and cons to things. Some of the disadvantages are that with that potential greater return, there's also a potential for greater losses. It's kind of that whole risk reward trade off. So if you're willing to put your money on the line, maybe you earn a bit more, maybe you lose a bit more. So keep that in mind. You got to have enough of a risk tolerance to kind of be able to stomach that. They are often more illiquid or like less liquid. Like we can't necessarily invest in an alternative investment and then the next day or 2 days later go in and be like, ooh, just kidding. I didn't want to put that in there. Let me get it back. So there will be specific redemption windows for most of them. Like maybe it's quarterly. Maybe you must have the money invested for at least 2 years. So it's very important that when you're considering options like this, that you know exactly what that's going to look like. If I put my money in here, when can I potentially get it back? What does the process for that look like? All of that kind of stuff. And then also, there may be limits to how much you can invest based on how much you have in your net worth. So maybe it's an investment where the maximum you can have in this portfolio is 10% of your total net worth, like maybe minus the value of the equity in your home. So those kinds of things can be important to consider because if the initial investment is $100,000 and right now you only have $300,000 of invested assets and you need to have it be no more than 10%, like that's not going to work. And obviously, like you'll figure that out along the way, but that is one big disadvantage or just potential roadblock from even starting to invest in these tools. The other thing is that, especially on the private equity side of alternative investments, that's just not as well regulated. Generally they face less scrutiny and oversight, and that can potentially introduce some more risk as well, and maybe make it less transparent, maybe a little bit harder to understand exactly what that investment is and what it's supposed to do for you. So I think in comparison to setting up a brokerage account with traditional like mutual fund and ETF investments, where like if you set up an account with us or Vanguard, you're going to get pages and pages and pages of disclosures because that's required. We have to disclose any potential fees, like all of that kind of stuff. So it can be hard to kind of sort through all that, but it's also very transparent, which is not necessarily the case when you're dealing with like alternative investments or private equity and stuff like that.
Yes. Definitely a little bit more of the Wild West in some of these cases.
Yeah.
But anyways, types of alt. So you mentioned direct indexing. I don't even know if this would be considered an alternative, but it is a little bit more unique, and you do need, at least at this point in time, more money to get into a direct index strategy. I'm guessing as time goes on, minimums will decrease just thanks to technology and fractional share purchases and whatnot. Um, but yeah, with most direct indexes, you probably need at least 100,000. Some require more depending on the company. It's designed rather than buying just an index fund, which is the easier route to go and simpler and slightly less expensive. You could do a direct index portfolio where they buy the individual stocks on the index. So if you're trying to mirror the S&P 500 index, option one is just buy an S&P 500 index fund. Super easy. You could buy it at any brokerage institution out there. The other option is if you have some more money and want to be more tax efficient, or screen out certain securities, you can do a direct index strategy. And they're not going to buy all 500 stocks on the S&P 500. They might buy two to 300 or so of them. But their goal is to try and replicate the returns of the index over time. There might be a little bit of tracking error, plus or minus a percent or two from year to year, but it should be pretty close. The big advantage here, for people, especially if you're in a higher tax bracket, is you can isolate the individual losers at any point in time. So if you own the S&P 500 index last year, 2024, great example. Stock market was way up, like 20 something percent. But like a third of the stocks on the S&P 500 were negative for the year. And don't quote me on the third, but it was, a decent chunk, somewhere between 25 and 40%. Google it. It's right around there. And that's pretty common in up years. Usually the heavy hitters, the big names carry the weight of the portfolio, like the top 10 stocks tend to drive the majority of the returns. And there's a bunch of other names that were kind of ho hum, or in some cases negative on the year. Well, if a third of the portfolio is negative, you could sell those losers, book those losses on paper, and use that to offset gains when you rebalance or just carry forward those losses for future years. So it can definitely be beneficial from a tax standpoint. And most of these direct indexing strategies tout that they save you about 1 to 2% per year, net of taxes. So their target after tax return is supposed to be about 1 to 2% per year better than the underlying index itself. No guarantees, of course. It's not going to be straight in a straight line. It's going to come in lumps when the market's volatile or in periods where they have opportunities to harvest those losses. But that's the big appeal of direct indexing, is being able to be more tax efficient, or in some cases like screen out securities. So if you work for an accounting firm, for an example, and you can't invest in the companies that you do accounting for, you could screen those out of the portfolio.
Yeah. I think real estate is another one that comes up very commonly, with clients and things like that. And investing in real estate, like in some ways can be an alternative investment. Some ways it's like, oh, this has been going on for ages. Like you can buy individual properties, rent them out, do whatever you want. You can invest in something called a REIT, which is basically sold and purchased like a mutual fund or something like that. And those are generally, well, the ones that I'm talking about right now are publicly traded, which means they do have a lot of the oversight that the typical like mutual funds and things like that have. And that just allows you to purchase portions of like some sort of property somewhere else where someone else is managing it and collecting rents and doing all those things so you don't have to do it. There are also private REITs out there, which are, again, probably a little bit less regulated, but potentially have some higher rates of return, maybe even doing something slightly riskier. It just really depends. But a lot of times those are private just because they're smaller. You know, maybe it's like a handful of commercial properties instead of like a giant mutual fund with lots and lots and lots of holdings. 1031 exchanges can be helpful with real estate because that can allow you to do some tax advantaged um, like buying and selling of properties. So what a 1031 exchange is it allows you to sell out of a property or like a real estate holding. And if you buy something very similar within 60 days, then you don't have to pay capital gains taxes on the growth in that investment. So it allows you to kind of kick that can a little farther down the road. Just like if you buy an S&P 500 fund and we'd prefer to not realize those gains until later, we can choose to not sell that. But with real estate, you can choose to sell it and still potentially pass those gains down the road, which can be really helpful. There's also ways to potentially generate income with real estate portfolios and strategies. Like if you're collecting rents and things like that, like obviously that can be a really helpful part of an overall strategy. When you are doing things like buying individual properties, it's just good to keep in mind that you have some concentrated risk there. You know, so if you lose some rent because you've lost a renter, like that's all on you. It's not like absorbed by a fund and a lot of other investors. So all of these things have their risk reward kind of thing going on, but keep in mind like when you are responsible for each individual step of the process, like that puts more of the work and the risk on you.
Yeah, and they all come in different sizes, flavors, objectives. Like, for example, we have a fund that we have access to that we've used for some of our clients that, for the last 20 plus years has produced at least a 5% annual income or yield on it, and they target about a 3 to 5% annual growth rate on the property value or the fund value, I should say. They own a bunch of properties, but so you get a little bit of a smoother ride. You get that income. Obviously, none of this is guaranteed. It is rather illiquid. You can't just get your money out whenever you want. They do have redemption windows and maximum redemption requests for the portfolio. So if everyone's trying to get their money out at once, you're not going to be able to. Um, but again, everyone has different objectives. If you're targeting that combination of income and modest growth, that could be a decent tool to look at. Another way to look at income and growth with some protections built in are structured notes, which we've talked a little bit about in the past, and these can be designed in all sorts of different ways. But they're essentially stock option strategies packaged into nice, neat, and tidy products for clients. So rather than you having to go buy and sell options and create your own collars and everything, it's just a nice, tidy little here's what it is, here's what it does. You can buy this from us, and us, not meaning like Rachelle and I, but like major investment banks sell them. Um, they're generally issued by the major investment institutions like the JP Morgans, the Goldmans, the Citibanks, et cetera, of the world. And it's just a debt instrument. It's a note. So you lend them money, they pay you the money back per the terms of the note. So the again, a lot of different variations. A common example are market growth notes, where your note is tied to an index and it often has downside protection. So, for example, we you get a 3-year note linked to the S&P 500. They'll give you the upside of the S&P 500, sometimes up to a cap, but the longer term ones generally don't have a cap. And then downside, there might be a buffer of 15% on it, for example. So if the market is up over that time span, you get credited with the growth. If the market is down, you're whatever the market was down by minus, or I guess plus 15%. So if the market's down 20%, you're only down 5% with a 15% buffer. If the market's down 10%, you're down zero, you get credited your principal back. So those are a nice way to participate in the upside while minimizing the downside. The big risk is though, if the issuing institution goes bankrupt or can't repay or defaults on their debt and can't repay all their lenders, then you may not get all your money back. So there is that risk. It's also, again, typically locked up for the duration of the note. If it's a 3 year note, well, you're not touching that for 3 years. It's kind of tied up. Can't get it out. So you got to definitely keep that in mind. And you can buy individual notes. You can buy um, ones that are managed in a portfolio. Like for example, I was talking with a company recently that offers a portfolio that targets income, similar to the real estate one, but using these notes, they target an 8 to 12% annualized income with some downside protections on the notes as well. But it has a minimum of $500,000 to get in. So again, not accessible to everyone, but for folks who do have a larger portfolio, retirees, for example, looking for consistent income in retirement, that could be a decent strategy for a portion of their portfolio. Not all of it, but a portion could make some sense.
Yep. Okay. So another kind. We've got buffered and leveraged ETFs, which you can look into. So these are available to anyone, which is kind of the nice thing. There's not quite as much of a barrier to entry. The buffered ETFs, they have like an upside index performance, but only up to a cap. So like, okay, we might get this return, but only up to 15%. Anything above and beyond that is going to be like basically absorbed by the fund itself. But then there's usually downside protection, which is the benefit of the buffered ETFs. So maybe we've got a 15% buffer similar to what Corey was talking about with the structured notes. So if the market is up 20, you're up 15 because that's your cap on how high it can get. If the market is down 20, maybe you're only down 5 because you've got that buffer on the downside. So with buffered ETFs, it's basically like downside protection. Leveraged ETFs are different. So this is basically like we're going to double down on everything that's happened. So if you're looking at like a 2 times leveraged ETF, which we had one podcast episode that talked about this a little bit with a couple of guests a couple of years back, which was cool. Maybe I'll try to link that in
Oh,
the
I
show
think that
notes.
was
But
that the one where
basic,
they were talking about real estate a little bit and how essentially using leverage because you're borrowing money like in a
yes,
mortgage,
yep,
your 100K down payment, if you sell your property for 100K more than you bought it for, you just doubled your money
yep.
um because
Yeah.
of
So
leverage.
this is like leverage ETFs are very similar. So it's basically like I think again using option strategies on the back end, but the whole I
I think it's just debt. They're just borrowing money to buy more.
oh gosh, of course that's
Leverage.
yeah, that oh my gosh. So it's risky for sure. So what happens is, if the market is up 20 because you use borrowed money like within the fund to bet on this, then you're up 40 because you're like, yeah, it's just a very complicated mathematical way to double your returns, but also it doubles your losses. So if the market is down 20, you're down 40. And those like big losses take a long time to recover from. If the market is down 50%, you've just lost all of your money because it's just now all going all back to the debtor, basically. So everything has to go back to what was loaned in order to make this leverage happen in the first place. So buffered ETFs may be slightly less risk than a typical mutual fund. Leveraged ETFs a lot more risk. So lots of very, very, very different strategies, but using the same kinds of ideas.
Let's see, private equity and venture capital, I'm lumping them together. It's kind of the same thing.
Same
Private
thing.
equity is private companies. I think I saw a stat on the internet, so it's got to be true. It was actually sourced by numerous reputable firms. 87% of companies with over 100 million in annual revenue are privately owned. So it means they don't have a publicly traded stock that you can buy. So there's a lot of companies out there that that are private and some of them need access to capital to grow. They'll take on outside investors or take on outside borrowed money to grow the company. And private equity funds allow you to invest in those. Again, private equity funds up until recently weren't really accessible to most people, but now through various investment banks, brokerage firms, etc. Like we have access to certain private equity strategies through some of our channels. It allows investors to tap into some of those markets. I think I've been reading private equity firms are trying to make a push into 401ks even and having it as a offering on 401k lineup. So that could be interesting if that happens in the future.
Yeah,
Um, but venture capital are more of the early stage startup companies. So private equity generally going to be a little bit more established companies, still privately held. Whereas VC, that's where like you're just blindfolded throwing darts, hoping something's going to stick. You invest in 50 companies, 40 of them aren't going to return anything. You're going to lose all your money. Eight of them might break even or get you a modest rate of return, and one or two of them are going to hit home runs. That's like your Airbnb, you know, the Uber, the et cetera of the world. Um, so the VC funds again, that's kind of their math. They just throw a bunch of stuff against the wall and see if any of it sticks is kind of the strategy there. um, Again, very illiquid. Most of that money is not getting returned to you. There's a good chance none of it's getting returned to you, but if you get lucky and hit some home runs with some of the holdings that they've invested in for you, um, and especially if it's through a larger well-established VC private equity firm, like there's a better chance you're at least going to get your principal back, or a portion of it back. But it's a risk reward game. That's all it is.
absolutely. All of it is. I will say, like, I have had clients come to me where, like, their practice is being bought out by private equity, and maybe they want to buy into that, and they're like very confident that, their practice is going to do well, so this should be a good investment. I think that that's okay to consider. It's something to be cautious about too, because your income is already tied up with your business. Like if your practice doesn't do super well for some reason, that can affect your income. If you on top of that also have invested money in there, that's going to affect that as well. So it's kind of like doubling down on the same thing. So it doesn't necessarily mean that you shouldn't do it at all, but maybe be cautious about how much you choose to invest, like how much of your financial well-being you want tied up in this one company.
Well, in a lot of those buyouts, they structure it part cash, part stock. Cash is king. The more, if your practice is getting bought by private equity, try to get it all cash. That'd be ideal because then you know what you're getting.
Hmm.
Generally, it's like 70-30, 80-20 cash to stock. They'll give you some stock. And the idea behind the stock is, they're not just buying your practice, they're buying a bunch of practices that are similar, roll them up into one big sale few years down the line is their goal. And
Hmm.
if and when that sale happens, that's when you potentially can cash in some of your stock. But I would treat that stock like monopoly money because it's not really accessible. You can't sell it. The
Hmm.
only way you're getting it out is if there's an equity event later on where they sell those, your company packaged with a bunch of others to a larger entity or hospital system or whatever, later
Yep.
down the road. So,
Read your terms and conditions.
and know like when you potentially can redeem your stock. Like, does it have
Yeah.
to be, can you even redeem it if they sell your practice again? Or like, what are the terms? Because that'll tell
Yes.
you when and how you can get that stock turned into dollars that are actually meaningful for you.
Money. Yeah.
Now, on the
Okay, on the other side of things, like from private equity, you have like the private credit and private debt. So, there's loans issued to companies and borrowers that are negotiated directly between the borrower and the lender outside of a traditional bank. And you could be the lender potentially, or you and a handful of other people could group together and be the lender. So you might be able to get better terms and more money. Like the borrower themselves might be able to get better terms and more money than they can from a bank because maybe like your individual investors are willing to take a little bit more risk. And then the investors could receive more interest than they can in a traditional bond fund potentially. The big downside, just like with bonds, but maybe even more so when there's not like quite as much of a structure involved, is that you may not see your money back if the borrowers default on their debt. And that's a very big concern, even for companies that are like doing okay. Like there's lots of companies that go away. Like I think we've talked about this a lot before, but like the top 10 companies in the S&P 500 do not stay the same from year to year. because some of them like go fail eventually. Some of them get purchased by other companies, which wouldn't necessarily be bad for you as a lender. But like companies come and go. They're not around forever necessarily. So just keep that in mind if you're trying to lend to someone privately or, do a transaction like that.
Yeah, the appeal for higher returns is really all it is here. It's like, oh, I could buy a
Hmm.
bond fund getting me 4% interest, or I could get into this private credit fund that's paying 11% interest. Ooh, 11% is greater than 4%. So I like that.
And if
But
they're
it
willing
comes
to
with risk.
borrow at 11%, they're probably in a little bit of trouble too.
Yeah, but it's that, startup company
Yeah,
needs some funding. Like, hey, we're on
can't get it
growth
from a
mode.
bank.
We're going to
Yeah.
get outside investors. We just need a 1 year loan at 11% to get this product launched, and then we're good to go.
Yeah.
So I mean that yeah, it might fail and flop, but um, it might also turn into a success. They pay back their lenders and then get access to more capital at a better interest rate. But yeah, it's all a risk reward game. So, and
Hmm.
that's where being diversified. Like, you don't just want to go lend to one individual. You want to kind of like the VC game, spread it out amongst hundreds or thousands of borrowers
Yeah.
so that, using if the private credit fund, if their management team does a good job of assessing the credit risk of the borrower and they do it across a portfolio, it's just a numbers game, kind of like
Hmm.
insurance. Some of them are going to default, they know it, but if they do a good job of assessing the risk and they know, all right, 90% of these borrowers are going to pay us back, 10% are going to default. All right, this is what our expected return is, and they can confidently do that if they've like done their homework. And not always, things happen. Do that, but
Yeah.
yeah, that's generally it's
Conditions
just a numbers
change.
game.
Hmm. Yep.
What else we got here?
Do
Com-
commodities. Yeah.
Commodities, pretty straightforward. Getting back to our old school roots as humans, it's just raw materials: oil, gas, metals, agricultural stuff,
Yeah.
corn, beef, etc. The things that we need to dig up from the earth to convert into
Yeah.
things for
Minerals.
consumption, products, etc. So
Buy some chickens because then when egg prices go up, you've got your eggs.
there you go. Rochelle's set. She doesn't have to buy eggs at the grocery store. She's got chickens
No,
instead.
no, I gave them away, but
But
but yeah, don't do that. That is actually not going to save you any money, just so you
yeah, it's
know.
probably more expensive to maintain and the chickens than it is to buy some
Economies of
eggs.
scale.
Yeah. But commodities, it's purely a supply and demand game. Like if there's greater demand for a good or a decreased supply or both, that means prices are going to go up. If it's the reverse, decreased demand, increased supply, prices go down. Um, Kind of hard to predict. Like, some things are a little more like we need corn to produce a lot of things in our world. Um, so there's probably always going to be some sort of demand for corn, but if we've got a drought and the cornfields can't produce enough corn, then yeah, the price of corn is going to go up. But if we've had a good year and we've overproduced corn, the price of corn is going to go down. And as an investor, that may not be ideal if you have a bunch of crop just sitting there going to waste. So it's
Hmm.
the precious metals fall in this category. I think I mentioned like gold. It's only worth what someone else is willing to pay for it. So as long as us humans want gold earrings and necklaces and want to bury gold in vaults and pay people to stand over it with rifles guarding it, then yeah, gold will have some value. But once we decide it's just we don't like gold
It's
anymore
just
because
shiny and we hate
yeah,
it. Yeah.
and it's not cool, then gold's not going to be very valuable. So
Yeah. Okay, hedge funds are a good example of an alternative investment. I feel like I want to go back and read The Big Short again because, or not read, I did read it, but also like watch the movie for sure, both of those.
both were good.
So, yes, so hedge funds may invest in any of these kinds of investments. It could be strategies or real estate, it could be debt, it could be stocks, it could be all sorts of things. And then the strategy will vary from fund to fund. Maybe the fund is trying to generate income. Maybe it's trying to grow as much as possible, as fast as possible. Maybe it just wants to be stable in the face of like economic downturn. The Big Short is specifically about, trying to earn money or create investment returns when the housing market collapses. And I think one of the big downsides of these, just like a lot of alternative investments, is that it's not super liquid. So that whole story is about how this particular guy was like, this is going to fall apart. And then it took much longer to fall apart than he expected. And so he had investors being like, give us our money back. And he was like, no, like, because it looked like he was just ruining everything and destroying stuff until it finally turned around like a much later than he expected. And like the people that actually stuck around long enough made a lot of money, like a
That
lot of money.
happens more often than you think, where people have a strategy, they just didn't time it right and don't
Yeah.
have the capital to stick around and see it through.
Yeah.
There's also, have you ever read the book When Genius Failed about long-term
I don't
capital
think so.
management, which
Uh-uh.
I don't know if it was a hedge fund, it must have been. In the late 90s, it literally almost brought down the entire global financial system because they were borrowing money from all the major banks, and then when they weren't able to meet their redemption requests, like they couldn't pay back all the lenders, and all these lenders were essentially, it was like a carousel of lending, and no one was going to get their money back, and like multiple countries were involved. Like it was a giant disaster. It was like all
Like
these quants
leveraged
from
hedge
MIT and
funds and
stuff.
yeah.
Yeah, so it's a
Yeah.
pretty good read. When Genius Failed. um
Yeah.
Guys who were too smart for themselves and lost everything and almost
Yeah.
caused the world to collapse.
There we go. So maybe hedge funds definitely have that like ooh, kind of vibe to them. I don't know what that vibe is, but you know what I mean. And then historically, they're also a bit more expensive. So if that's something you want to try out, expect to pay a much higher management fee, maybe a percentage of your profits. So yeah, maybe they can hit it out of the park for you, but it's going to cost you some money, and maybe they won't hit it out of the park. Maybe you'll be banging down their door and asking for your money back, even if it's, only half of what you originally invested.
Yeah, if you're investing in a hedge fund hoping you're going to get better returns than your general index portfolio, probably unlikely. Like you want, just due to the costs, it's like
Yeah.
hard to. Now, there's a few all-stars out there that are definitely worth their costs,
Or
but it's
have
hard.
been in the past, but we don't know if they
Bingo.
will be in the future.
Yes, have been in the past, no guarantee of future. And then there's going to be some up and coming shining stars. You just don't know in advance which ones those are. So it's
Yeah.
I'm not a big fan of hedge funds. If it's something that, if it's a strategy that appeals to you and you like what they're offering and works for your objectives, and sure, just like any of these things, most of these things we just ran through are not going to be appropriate for you. But in some
Yeah.
cases, one or two of them or more potentially might be appropriate for a portion of your portfolio, depending on what the objectives are. Like the income one I mentioned in retirement, you might want income. All right, we can find a way to generate income. You might want stability. All right, we can find a way to try and generate a little bit more stability. You might want to just keep things simple and
Yeah.
easy and not have to like track and understand and have your money tied up. Like, so are these right for you? It really depends. Like, do you want diversification beyond your typical stock, bond, or REIT portfolio? Do you want something different, cool, sexy that you can brag to your friends about? Um, Not that these are necessarily cool, but it's different. And
Yeah.
and sometimes that feels like, ooh, I got something different than my friends. So they're going to be jealous of me. But I mean, what's your time horizon?
And
You're
then you
after
won't tell
retirement?
them when you lose money, so they'll
Yeah,
think it's good for
exactly. Like,
you.
oh yeah, that private equity fund, I didn't get any of my money back. I just lost 100 grand. Like, that's not as exciting. Um,
Mm-mm.
but the one that doubles your money in a 5 year span, that one's a little more exciting.
Yeah.
It's kind of like your gambling in Vegas trips. Like you tell the stories about the time you won money, but not about all the times you lost money. So,
Yep. Yep.
um, can you afford to lose? Speaking of losing money, the money you're investing in these strategies, like in some cases, depending on the risk reward spectrum, there's a decent chance you might not see that money back. And the lack of liquidity too. Are you okay with not being able to access the money for a period of time? Like especially some of these real estate ones. Like if you're buying an individual commercial property and they might be targeting a time horizon of selling it in 5 to 7 years. Well, your money's locked up in 5 to 7 years, or potentially more if it's not an ideal
Hmm.
time to sell it. Your money might be locked up for decades. So, are you okay with that? There's no historical track record suggesting any of these strategies will do better over time than your traditional stock market index portfolio. But maybe getting the best returns isn't necessarily the objective. And really it shouldn't be. Reaching your goals in a timely manner should be objective number one. And again, diversification, having a smoother ride, producing income, that might be more important to you than like beating the benchmark or something. So um, again, it's not necessarily the if you can access these, do it because you're going to get better returns. Like far from that. You also might not. And it's going to be more headaches involved potentially along the way. Um, so yeah, nothing's
We're really
guaranteed.
selling it here.
We are very much so. I think again, in certain circumstances, they can make sense. But this isn't like, oh, I need to have alternatives because I'm gonna do better. Like, no, if you don't at all. You might want them for one reason or the other. And I can make arguments
Hmm.
for
Yep.
certain strategies in certain people's portfolios. Like I had recently met with a person who's like, I want a guaranteed income stream and I'm willing to pay for it. So an annuity makes sense. Doesn't make sense for everyone, but if you're someone who wants to convert a portion of your retirement nest egg into guaranteed income, yeah, you should probably look at an annuity. Like that's the right scenario for that product. An annuity for Rachelle and I, who are still a ways away from retirement, trying to say we don't need guaranteed income from a product right now. We need to just keep saving and accumulate. So it doesn't make sense for us. But
Yep.
everyone's circumstances are different.
Yep. I think also when you are looking at these kinds of investments, like take everything with a grain of salt. If it's like, oh, you're going to get 12% per year. Okay, understand that that's not a guarantee. That's not necessarily what you're going to get. So always keep that in mind. And I think in general, if you are a person that likes things to be simple, probably none of these are for you. Like maybe, but probably not. Like if you just want to keep things simple, do a simple, like diversified mutual fund portfolio. That's all you really need to do in order to save enough for retirement. Well, you have to save enough, but you don't need to use a lot of fancy tools and things to get there. It's just optional.
For sure. Well, thanks for
Yep.
listening, everyone. See you next time.